Good morning, everybody. My name is Richard Cuizio. My friends and family call me Ricky, and I am a loan officer with Hudson United Mortgage. I am licensed in the states of New York, New Jersey, Connecticut, and Florida, and I'm here to talk to you today a little bit about, our topic for the month is health and wellness. So I've decided to talk about whether 30-year mortgages are bad or good for your financial wellness. And that being said, I'd like to go into a little bit of history um, about the 30-year mortgage. Now, before I do so, if anybody has any questions or comments after the show and want to get a hold of me, you can always give me a call on my cell phone. My contact information is area code 321-634-2552. Or you can always shoot me an email, which is richard.cuzio@hudsonunited.com. That's one word, hudsonunited.com. So that being said, let me get started. So our 30-year mortgage is bad for your financial wellness. The 30-year mortgage started and was created after the Great Depression under the premise that Americans would pay off their loan during their working years. By the time you're retired, a lot of Americans or working families or citizens, I should say, would like to be done paying their mortgage by the time they retire. So while many credit 30-year mortgages for the accessibility of home ownership, the resource that I've been getting some of this material from, which is Forbes magazine, said that there are several rising concerns over the amount of interest consumers pay and the recent abuses in the mortgage system or the loan system. So let's break that down a little bit, okay? So, for example, and I'm just going to use fair numbers here. Obviously, different parts of the regions have different parts of the country are going to have different sales prices in their homes. Different types of homes are going to have different prices. But I would say, for all intents and purposes, since I primarily work out of New York and Westchester County, I'm going to be using a financing home amount of about $500,000. So, if you buy a home and you finance it for the amount of $500,000 and you obtain a 30-year mortgage at, just ballparking here, I'm not saying that this is today's interest rates, I'm just using fair round numbers at a 4% interest rate. So $500,000 financing, 30-year mortgage at a 4% interest rate. The total interest over the life of your loan over that 30 years ends up being approximately $359,347. So you are paying almost $860,000 for your $500,000 home because you're paying that much interest over 30 years. Now, if you decide to utilize a 15-year mortgage for the same house, on average, 15-year mortgage, your credit's got to be in good standing, but so does your income. So what happens is, on average, when you're pricing out a 15-year versus a 30-year scenario, you can usually get anywhere between an eighth and a quarter percent or higher better on your interest rate for that loan. But for argument's sake, let's just go with a quarter percent better. So on a $500,000 loan at an interest rate of 3.75 or 3.75 over 15 years, the amount of interest that John or Jane Doe home buyer is going to be paying is $154,500. So now the difference in the total interest between that 30-year and 15-year loan is approximately $204,847. $205,000, I'm rounding up, approximately $205,000 in interest that you're going to be saving on that house between a 15-year and a 30-year loan. That is huge. Huge. That is, let's take that into consideration. All right. So when you're buying a home, and if you can afford to do it, and you make a comfortable salary to support your living, to support that type of living, that type of home, and any extracurricular activities that you have outside of your home, outside of your work, then something like that I think would be extremely worth it. For some people, the savings on that on their total interest for that mortgage in a scenario like this, you know, it can pay for their kids' college tuitions, or maybe this person or that person that had just done this type of deal, maybe they're a property buying hound. So the $200,000 that they're saving on their interest can afford to buy them a second home, maybe somewhere tropical like Florida, or somewhere warmer. If you live in the north, you maybe want to go to Arizona or California, or maybe you just want to buy a condo, like a second condo somewhere on the beach, Myrtle Beach or Virginia or something like that. So, you know, it could also, you can also buy two brand new cars and still have some money left over to put in the bank if you wanted to. So 200, you can do a lot with $200,000. You can reinvest, you can buy some stocks, you can buy bonds, annuities, whatever you want to do. You can play the stock market, you can go to Vegas, you can go on vacation. So $200,000 is a lot of money to save in interest over the life of your loan. One of the benefits, another benefit to a 30-year mortgage is your payment flexibility. The lower 30-year mortgage offers payment flexibility for those future changes. So you can pay your 30-year mortgage at a pace of a 15-year mortgage, and then you could drop it down to a 30-year payment when your change in your income occurs. When you're paying a 30-year mortgage, the way that the amortization schedule is set up, you are always going to be paying more interest on your mortgage for the first 15 years of that loan. At some point in year 15, you're going to be paying the exact same interest and the exact same principal uh, for your mortgage. After year 15, you start paying more of your principal than you do your interest. But for the first 15 years, you're always going to be attacking more of your interest um, when you're making your monthly mortgage payments. So, that being said, here are some other options for the home buyer that are available when it comes to your payments. You know, for instance, you don't have to settle for a 30-year mortgage. You can get a 25-year mortgage, a 20-year, a 15-year. Hell, you can even do a 10-year mortgage if you wanted to. Now, there are certain benefits to getting these lower term mortgages, and then one of them is being the total amount of interest that is decreased over the life of your loan. That's just one of them. Another one is the amount of equity that you're building up in your home. So because you're lowering your term, you're ultimately reducing the amount of interest that you're paying over the life of your loan, but you're also increasing the amount of principal that you are paying off on that loan too. So the more principal you pay off, the more equity and stock you have in your home, the faster you technically own your home. Um, so if need be, later on down the line, maybe you find yourself in a bind, or you want to do some renovations in the house, or go on vacation, or your kids grow up and you need to pay off their tuition, or maybe you have accrued a lot of debt and you want to consolidate it. Having equity in your home will allow you later on to do a cash out refinance, take some of that equity back out that you've been working so hard to pay off, and you can do any one of those things, and you can pay off your debt and you can consolidate it. Now, I don't know about you, but um, it took me several years to pay off my debt, and which I'm proud to say that I'm still paying. I'm not paying it off anymore. Now I'm paying it down to a $0 balance on a monthly basis. However, if you aren't not doing that, realistically, your interest rate on your credit card is probably, oh, I'm going to spitball here, anywhere between 15 and 22%. So if you've got a $10,000 balance on your credit card, and you're just making the minimum payments, you're paying 22% on that $10,000 every month, and it seems like you're getting nowhere. So doing this cash out with the equity that you've built up with a shorter term on your loan, you know, you can do some cash out, you can roll those credit cards in, eliminate that debt, and pay your credit cards off at a 3 to 3.5% interest rate on, you know, average, instead of a 15 to 22% interest rate. I mean, that's a no-brainer. That sounds like a hell of a deal, and I would jump on it if I had the chance. So, you know, those are some benefits to doing loans like this, allowing you to get more equity in your home a lot faster. Now, there are some downsides as well. You know, the downside is that you are obligated to pay a higher monthly payment. All right. The shorter the term, it's only natural. The shorter the term in your mortgage, the more money you have to pay every month. So let's go back to that example that I used, with the $500,000 home. Um, Using that same scenario, $500,000 financing at a 3.75% interest rate over 30 years versus 15 years. The difference that you are paying monthly is approximately $1,300. That's a big chunk. $1,300. That's probably your monthly and extra annual property taxes if you're living in the state of New York, give or take. But you're paying like I said, you're paying a bigger chunk of principal at that time, and you're paying less interest, but you are paying $1,300 more a month to do so. However, what you could do is you could still do that 30-year mortgage, right? Save that $1,300 by not being obligated to pay it, and attack your principal by making an additional payment and just pay that $1,300 towards your principal. That's an option as well. 30-year mortgages are good for those who are not planning on staying in their home for 30 years because maybe they're retiring, maybe they plan on retiring and moving away, selling their home, or maybe their job that they currently have, causes them to move around a lot. Maybe you're, an architect and have to move. Maybe you're in the military and you have to move and you're constantly getting transferred from base to base. A 30-year mortgage might be good for them because it keeps their payments low and it gives them the flexibility and the options to pay off that additional principal at any given time to save money instantly every single month. And then, you know, the rest of the money they make back off the sale of their home. 30-year mortgages are also good method for when you're refinancing. Anybody who is over or anyone who is currently paying a 4% interest rate or higher on their current mortgage in today's market is a prime candidate to refinance their home. They can lower their monthly payments and they can save money every single month by doing so. They can also eliminate some of the interest over the life of their loan. So if you're paying over 4%, you're paying 4% interest over your original loan. You refinance to 3%. Now you've probably just knocked away $50,000, give or take, on your interest over those 30 years by, doing your refinance. So once again, $50,000. It's probably it's a very nice car or a truck or whatever you want to call it. You know me, I'd probably buy a new Chevy Malibu with it, but that's just me. Um, so you know, um, another option that I used to recommend when I worked at the bank, which is one of the options available. Now, not all lenders will do this because it depends on the payment schedule, but there are some institutions and banks and lenders who do give this option. Um, it's called a biweekly payment. Now, um, this is a very good option to utilize, and I'm going to explain to you why. What is a biweekly payment? Well, it's the same as a biweekly paycheck. You know, for those who get paid biweekly, you're getting paid every 14 days, which means in the span of a, calendar year, in a 365-day calendar year, there are 2 months out of the year that you get a 3 paycheck month. You get paid 3 times, twice in 2 months out of the 12 that year because you're getting paid biweekly, which is every 14 days. So a biweekly payment is the same schedule, is the same structure. However, every 14 days, you're making a half mortgage payment. So if your mortgage payment, total mortgage payment is $2,000, every 14 days, you're paying $1,000. So 2 months out of the year, you are making an extra half payment on your mortgage, which means at the end of the year, you would have made one extra full payment per year. What does that equate to? I'll break it down. On a 30-year mortgage, you have just eliminated approximately 4 years of interest and principal on your loan. Now, on average, sometimes quicker, depending on your loan. Now you own your home in 25 or 26 years instead of 30, just because you've done a biweekly payment. You've also eliminated some interest and you've earned more equity a lot quicker. So that is another option. It is a very good option to utilize. So if the options are available and you feel comfortable doing it, do it. Why not? You're only benefiting yourself in the long run. Now, there are some tools available that I have done some research on. If anybody is interested in calculating how fast they can earn their home, buy or own their home, it's called a mortgage. It's called an early mortgage payoff. And just go to Google and you type in early mortgage payoff calculator, and a bunch of options and links pop up for you to click on. Just find the one that you're most comfortable with, and it's the most easy to read. And what it does is it calculates, the amount of your financing at your interest rate in the life of your loan, and then it gives you the option to calculate how much money you want to pay per month in additional principal, and then it calculates how fast you will own your home. So for instance, I did this for a client, and he's closing on his house next week, which is great. I was happy to get this done for him. He's doing a 30-year mortgage. He's got a 2.625 interest rate. Yeah, that's how low I got him. So, you're welcome. If you need, and if you want an interest rate like that, you give me a call, 321-634-2552, or shoot me an email at richard.cuizio@hudsonunited.com. And I'd love to have a conversation with you. So getting back to this guy, 2.625 for a 30-year mortgage. He asked me to figure out how fast he can own his home if he paid an additional $1,000 per month. Now, since he's closing next week, he's not going to have his first mortgage payment until March of this year, 2021. I said, okay, so roughly right now he's paying about $1,800 or $1,900 a month for his total principal, interest, taxes, and insurance. It's total monthly payment. So he wants to throw in an additional $1,000. So I did the calculation using one of those websites. A good one to go to is bankrate.com. If you want, I used a different one, but they have a bunch of different types of schematics and calculations at bankrate.com for mortgages and stuff like that. So if he pays $1,000 extra per month, an additional principal, the calculations came out, he will own his home free and clear in 13 years, knocking off 17 years of interest and owning his home 17 years faster. So the little 2-year-old or 1-year-old, I forget how old the kid is, that he's got going on right now, by the time that kid is in junior high, this couple would own their home by the time this kid hits eighth or ninth grade. Isn't that crazy? $1,000 a month, and you're knocking off 17 years of your mortgage. So, these are the benefits. There are some good benefits. There are some downside to it as well. Being obligated to have to pay a higher monthly payment. Some people are able to afford it. Some people are not. It all depends on your scenario and what you're comfortable with. So that being said, that concludes my presentation on whether or not a 30-year mortgage is good or bad for financial wellness with you. So if you have any questions, um, you can always contact me, and I'll give it back to these gentlemen.
Thank you, Rick. And using you as an example, we refinanced our mortgage for 30 years. The interest rate, you got to save us $500 a month. So we reinvested that $500 towards principal every single month. So we're paying exactly the same as we were paying before the refi, but now $500 of that is going directly towards principal every single month.
Correct. And the reason, and I did this for Oscar and his wife a couple of months ago. The reason that they decided to do that, one, was to save the money, reinvest it into their principal, but they're moving to Spain. Yeah, they already told me their plan. So, they're going to make the rest of their money back off the sale of their home, plain and simple. So for them, this was a good product. If they were living there, if they were going to live and ultimately finish their life in that house, we would have went with a 15-year term instead. But the fact of the matter is that they wanted to save money. They wanted to put it towards their principal, and they're not going to live there for longer than 5 or 10 years. And they've got a plan. They're moving. They're going to Spain, and they're taking me with them, they told me.
Wow.
Well,
Ricky,
we're going to drop them off halfway. We're not taking them all.
Somebody on Facebook was asking about FICO 10.
FICO 10.
Yeah,
So
what is
here
that?
is, so right now, currently, a lot of institutions now is supposed to roll out last summer. It's a very good question. FICO 10 is it's going to be adapted by a lot of mortgage and banking institutions. Right now, I think a lot of the institutions are either using FICO 4, 5, 6, maybe FICO 8. However, FICO 10,
Mhm.
all right, right now,
Correct.
when we run credit report, it it takes into account all of your installment and all of your revolving debt, which is your credit cards, car payments, boat payments, mortgage payments, home equity lines of credit payments, anything like that, student loans. Those are all accounted for. When FICO 10 comes into play, all right, the difference is
Mhm.
now there are going to be utility bills and cell phone bills accounted for with your FICO credit score. So not making late payments on these utility bills, water bill, electric bill, cell phone bill, internet bill, all of these are going to be accounted for. Gas bill, electric bill, whatever it may be, your water bill. Um, it's going to affect a lot of different people in a lot of different ways. Either their credit score is going to go up because maybe they're concentrating on making their payments on time to their credit cards and their mortgages, and maybe not so much to the utilities because they can get away with a $15 or $20 late fee and it doesn't really affect their credit score. However, once FICO 10 comes into play, that's not going to be the case anymore. Now all those utility bills, they're going to show late payments, and it's either going to go down, it's going to go up, or there's not going to be any change depending on your scenario and how you pay your bills and if you pay them on time.
Is that going
So
to be based on past payments as well, or
you know
just?
I'm not exactly sure on the past payments. I don't know if they're going to roll out FICO 10 and then start from there, or if they're going to include a history. I don't, I don't have an
I'm not
answer to
sure.
that. I'm
Okay.
not.
Okay.
I'm not. I
That's,
could find out, and that would be somebody to reach out to. There are some resources out there. I do have a contact. His name is Eric Sturkin. He is a credit specialist, and he works with Better Qualified Consulting, and he pretty much works directly underneath the credit bureaus and reports directly to them. All the credit information and knowledge that I have is from taking his classes. And you can reach him at eric@betterqualified.com, but I'll double check on that. I'm pretty
right.
sure.
Maybe we
But
can have him
yeah,
on the
I got
program
his
one
number.
day.
I would love to invite him, and do a credit
Yeah.
segment. Him and his people. I mean, man, they're phenomenal. They're uplifting and they're upbeat. But for intents and purposes of this FICO 10 conversation, that's what's going to happen. They are going to incorporate your utility and cell phone bills into your when your credit is run. So now I'm going to see all of that history
Mhm.
whenever everything is adapted and changed over.
Right. And I'll invite Dwayne Reed again too, just to get that and see if he has any more information as well. That's awesome.
Cool.
Thank you for that.
Welcome.
I mean, now you made a great suggestion about making biweekly payments. I want you to kind of emphasize that a little bit more. What is the benefit of doing that again?
The benefit of doing the biweekly payment, like I said, not all institutions will offer it. It depends on the lender, the bank, or the institution that you do your mortgage with. If they don't offer biweekly payments, then you're just going to have to settle for making an additional payment on the side at your convenience. However, if you do a biweekly payment, one more time to reiterate, it is a every 14-day
14 day
pay schedule. Just like we get paid bi-weekly, you're getting paid every 2 weeks or every 14 days. So 2 months out of the year, you're going to have 3 paychecks. You usually get one on the 1st, the 15th or the 16th, and again on the 30th. And that's a good
Right.
month. You're like, yeah, I get 3 paychecks this month. It's always good to have.
Right.
Same concept applies. You're making, and these 14-day payments every 14 days, they're not full mortgage payments. They are half mortgage payments. So you're making 1/2 mortgage payment every 14 days. Technically, you're still making your full mortgage payment every month, but the way the schedule falls, because of those 2 extra months where you have, the extra payment, you're making, at the end of the year, you're actually making one extra full mortgage payment that year, which will in turn reduce the life of your loan 4 to 5 years on average. So you're eliminating, you are now, just by making one extra full payment per year over the life of your loan, you've turned your 30-year mortgage into a 26 or a 25-year mortgage. So you've owned it that much quicker, and you've saved 4 or 5 years worth of interest, not paying interest on your mortgage.
So that's like phenomenal, right?
It really was. It really is a good product. There were a lot of people when I was working at the bank who did jump on the biweekly because they liked it, and then they still made additional payments on top of it. You could do that at any time.
Right. And you're cutting down the amount of the term. Basically, you're cutting into the term by doing.
If somebody offered me to do that and say, hey, would you like to own your for the same amount of money, would you like to own your house in 25 years instead of 30? I'd say, yeah. Does a bear go poop in the woods?
Quick question: Do you suggest we do the biweekly payment also on top of the 500, or that doesn't matter for me?
Well, you guys are paying an extra $500. I would assume a month. I would think at that point it really kind of doesn't matter. You'll have to check with your lender to see if you can schedule biweekly payments up that way. I don't know if they do, but then again, I've never. I honestly don't know. So you'd have to check with them, but you're paying so much additional principal. I would think you're probably good where you're at.
All right.
My other question was, so if somebody wants to start the process of buying a home with you, what do they need to do?
So first, they need to get a hold of me. They can reach me at my email address, richard.cuizio@hudsonunited.com. Give me a call on my cell phone, area code 321-634-2552. First, let's make sure we're employed. Got to be working, guys. Can't get a mortgage if you don't have a job and you're not making any money. I know a lot of people are displaced because of COVID. So if you've been out of work for longer than a 3 or 6 month period, it's going to be very hard to qualify. But if you have been an essential worker and are currently working and are looking for a home because the market is hot, the rates are low, and we're at an all-time low in the real estate industry, let's get you pre-approved. That is going to be the first step. We got to dig into your assets. We got to dig into your income, and we got to check your expense and income debt ratio. And I would be more than happy to do so. Once I do all that, I can get you pre-approved and let you know what you qualify for in order to buy a new house, second home, condo, co-op, whatever you want. I do residential properties, co-ops and condos, single family or 1 to 4 family investment properties as well. So we got to get you pre-approved. That's going to be the key, because a lot of realtors and sellers will not take any offers, and the realtors won't show you any properties if you have not been um, vetted properly and got a pre-approval letter from a licensed agent such as myself or somebody else.
So Phil, quick
Yeah.
question. Dwayne Reed, who
Mhm.
does credit repair, I
Mhm.
think would be a good time to have him on with Ricky, because if you said, like, I'm thinking of buying a house, I
Mhm.
think the first step is get a hold of Dwayne and say, I need my credit score up as high as possible before I even start the process. Does that make sense? It's like, okay,
That
let's,
makes sense. That makes
yeah,
sense. That makes sense.
because
Well,
before,
actually, that's the question for Ricky too.
yeah,
Like,
before you get your mortgage approved and everything, what's your credit score going to do with the interest rate that you're paying?
mhm.
So, get those ducks in a row while you're talking to Rick and then talking to Amanda. So all these people need to be all, lined up before you really start the process of looking for a house. The last thing you want to do is, as Rick and Amanda said yesterday, is like find this beautiful house that you want. Everything's good, but your credit rating says your interest rate's going to be 25%. There's just no way
Right,
they're going to give
right.
you a house.
Or you got to put $60,000 down, and
Right.
you're like, ooh, okay,
Ooh,
right,
okay.
right.
I
Well,
like
not
my
only
apartment.
that, but there's so many lenders are adding COVID overlays. Um, you know, your DTI, your score, your credit score is going to come into a big factor. Oh, we'll let you, we'll lend on this, like, normally with a back end ratio on a FHA loan, you can go up to a 56%.
Mhm.
However, if your credit score is lower than 660, guess what? They won't loan on over 50%, even if you do have an FHA loan. So now you just lost 6% of your expense and income because you got a low FICO score. It will impact your interest rate, certainly. It's also going to impact the months of reserves you might need to have in the bank, when doing this loan. And if anybody's wants to get a free credit report, any consumer is allowed to do so one time per year. Um, and you can find it at annualcreditreport.com. That's one word, annualcreditreport.com. You can pull up your credit report and you can look at your numbers and your credit history one time for free. Anytime after that, you got to pay, but everybody is entitled to a free credit report as a consumer one time per year. Annualcreditreport.com.
Nice, nice. That's great information to have. Ricky, thank you again, my friend.
Thank you guys for having me. It's always a pleasure.
Absolutely, absolutely. You rock this presentation, man. And if you want to reach out to Ricky, of course, you see the information on the banner below. We have Karen Mayo, who will be coming up next. She will be doing mindful eating in the kitchen, and she's going to be cooking up something healthy for us to give us an idea as to what we can do in the kitchen right now with one of her recipes, one of her personal recipes. So I can't wait to see what she does with that. And
Will it have bacon?
Love
Will there
Karen
be
Mayo,
bacon in it?
It won't have bacon,
but
I
it will have
guarantee
mayo.
you. It will have mayo.
It will
But
have mayo.
everybody
BLTM,
needs
baby.
a little more mayo. Yeah. So you can tell we're big fans. And also Frank Coppola will be on following Karen, and he'll be talking about ways of 7 steps of building wealth. So we don't want to miss those programs. You want to stay tuned for that, and we will see you in about 15 more minutes. Take care, everybody. Bye bye.
Bye, everybody. Thank you.